Welcome, you curious learner, to another deep dive. We are jumping straight into some extremely current and frankly compelling market intelligence today. We're analyzing the source material directly from the weekend reports of the Reserve of KING-KAMBUF Financial News and Reports magazine. This isn't just about reading the headlines, it's about the tactical breakdown you need right now to understand how money is moving globally. I have to admit, seeing the numbers in the weekly market digest from Saturday the 13th and then the follow up in the financial digest report on the 14th, it genuinely took my breath away. We are standing here in mid-December 2025, a time when the market is flirting with all-time highs, yet the market just gave us one of the most confusing, whiplash-inducing weeks of the entire year. Okay, let's unpack this. The Dow hit record highs, the S&P 500 reached a huge psychological milestone. But if you are holding certain high-flying, highly valued tech stocks, especially those tied to the AI infrastructure boom, you got absolutely crushed. It was a tale of two vastly different markets, and the divergence has some really serious implications. Our mission today is surgical. We need to cut through all that noise to understand precisely why the previously unstoppable AI rally suddenly paused, where the institutional money is actively rotating, and how you can position yourself for the week ahead based on KMUS meticulously detailed analysis. This transition phase is critical, and, understanding its mechanisms is the difference between capturing gains and sustaining some major losses.
What's fascinating here is the sheer velocity and the scale of the shift we just observed. You're right, this is not a market crash in the traditional sense. We're not seeing a sudden universal decline across the board. Instead, it's a massive, and I think necessary, shift in capital flow. It's driven by a renewed scrutiny of valuation and, more importantly, concrete earnings. We're witnessing an abrupt migration. The money is moving out of pure AI euphoria, where, high capex promises were enough, and into sectors that offer disciplined value, clear earnings visibility, established financials, and old economy strength. To properly diagnose the intensity of this rotation, we have to analyze the convergence of the three main catalysts that hit the market all at once. First, we had what should have been a universally positive policy event, the final Federal Reserve rate cut of 2025. That was quickly overshadowed by the genuinely shocking technology earnings misses and some severely disappointing guidance from bellwether names. And that in turn triggered the stampede, the subsequent rush toward defensives and cyclical sectors, forcing the major index split we need to analyze immediately.
Let's start right there with that confusion, because without context, the headlines make absolutely no sense. If you only looked at the Dow, you'd assume the champagne corks were popping all week. But the reality, as detailed in the KMBUF Report's weekly index summary, shows extreme market schizophrenia for the week ending December 12, 2025. This staggering divergence is, I think, the core story of the current market structure.
Absolutely. When we focus on the Dow Jones Industrial Average, that index which serves as a proxy for traditional American economic and industrial strength, it closed the week up a very robust plus 1.6%. More importantly, it achieved a massive new all-time closing record high of 48,704.01.
48,704. That's a huge number.
It is. And the peak surge came on Thursday, December 11, when the Dow shot up 646 points in a single session. This performance is an unmistakable signal of profound strength in traditional cyclical sectors. We're talking the banks, the manufacturers, the materials companies.
And the other major indices, well, they really struggled to keep pace with that strength. You contrast that Dow performance with the S&P 500, which is usually the benchmark of market health. It managed only a meager plus 0.45% gain for the week.
That's practically flat.
Exactly. And while it technically reached a new all-time high of 6,901, a significant psychological milestone, it spent the latter half of the week just consolidating and really struggling to maintain any upward momentum. For the year-to-date, it's still strong at plus 17.33%, showing that the long-term trend remains positive, but the weekly performance clearly signals friction just beneath the surface.
And if the S&P showed friction, the NASDAQ KING-KAMBUF showed outright pain. This index, the home of all those high-flying tech and growth stocks, it significantly lagged the others. It finished the entire week hovering around 0% change of flat line. But that flatness masks severe internal stress. Crucially, the NASDAQ suffered a sharp 1.7% drop on Friday alone.
And that Friday performance is the key tell, isn't it? The selling pressure was accelerating, not easing, as the week closed out. This wasn't minor profit-taking, it was active capital withdrawal.
As a liquidation event.
Yet, the reports point to a crucial nuance that makes this divergence so interesting: the performance of the smaller companies. The Russell 2000, which tracks small-cap stocks, was the dark horse of the week, surging a very strong plus 2.7% to new highs. This is where I want to challenge you, though. If small caps are surging that much and the Dow is at new highs, isn't that proof the market is fundamentally fine? Maybe this AI thing is just an isolated sector issue focused only on a handful of mega cap stocks. Why should we worry about broader volatility?
That is a brilliant and necessary question, and the answer, I think, defines the current moment. The small cap performance, the broadening of the market, is indeed a sign of underlying economic health. There's no question about that. When the Russell 2000 hits new highs, it suggests confidence in the domestic economy extending beyond the narrow leadership of the largest companies. However, we have to view this through the lens of history. The market engine that has been driving the indices for the past 18 months, the largest, most concentrated tech stocks in the NASDAQ, is now sputtering. And when your most heavily weighted components fail, as they did last week, it instantly increases the overall volatility risk for the entire index structure.
So even if the little guys are doing well, the big guys can still sink the ship because they're so heavy.
Exactly. You have underlying strength, yes, but your former leaders are crumbling under valuation pressure. That combination creates high correlation risk. If a few of these huge companies fall hard, they can still drag the entire index down disproportionately due to their massive weight.
That structural risk is what we need to keep top of mind. Let's rewind briefly to Wednesday, December 10th, because the first major event that drove the Dow higher and provided a psychological cushion was policy-related. The Federal Reserve cut interest rates.
That's correct. The Fed cut rates by a quarter point, which was widely expected, marking the third such cut of 2025 and bringing the new target rate to 4.75%. The immediate knee-jerk response was exactly what the Fed intended, universally positive, particularly in the financial sector.
And the response in the financials was dramatic. We saw financial stocks surge right out of the gate, instantly benefiting from a lower cost of capital and better forward visibility. Visa and MasterCard, in particular, recorded their best daily performances since April. That's a major signal of both market relief and renewed confidence in the financial sector's ability to thrive in this kind of high but stabilizing rate environment.
And crucially, Fed Chair Powell's commentary was highly supportive. His tone was decidedly dovish, promising continued support for liquidity. They backed this commitment up with a new Treasury purchase initiative, what the reports refer to as the T-bill program.
Okay, can you just break that down for us? What is the T-bill program and why does it matter?
Sure. For our listener who might not track central bank acronyms, the T-bill program is essentially a mechanism where the Fed actively buys short-term Treasury bills. By doing that, they inject liquidity back into the financial system, specifically aiming to ease pressure in the overnight funding markets and ensure banks have ample cash on hand.
So the Fed gave the market exactly what it wanted. Lower rates, a dovish tone, and a commitment to liquidity. It sounds like a perfect recipe for a rally.
Precisely. However, Powell still had to acknowledge lingering inflation concerns in the accompanying statement. But the market chose to focus only on the positive stimulus. Yet, here is the crucial takeaway, which we really need to emphasize, that rate cut euphoria was incredibly short-lived.
Like one day.
One day, maybe a day and a half, it provided a powerful one-day sugar rush, sending the Dow to a record high on Thursday. But that positive momentum was almost instantly overshadowed, even neutralized, by the severe earnings disappointment that came roaring out of the technology sector. It proved that fundamental concerns trumped monetary policy this week. The rotation had already begun beneath the surface of that euphoria.
All right, this section is the core mechanism of the sell-off and the definitive reason for the NASDAQ's painful week. The market was already nervous about tech valuations sitting at near historic peaks. And then two major earnings reports served as the definitive catalyst for institutional rotation. It proved that even slight misses can trigger monumental capital flight in a stretched market like this one.
We'll start with Oracle Corporation, or ORCL, announcing results for fiscal Q2 FY 2026. This was the first shot across the bow, and it signaled deep systemic trouble for the massive capital expenditure narrative surrounding AI infrastructure.
The numbers themselves weren't a total disaster, but they were certainly disappointing. Oracle reported revenue at $16.6 billion, just missing the consensus forecast of $16.21 billion by about, negative 0.93%?
Yeah, it's a small miss in absolute terms. However, digging into the reports, the software revenue component was actually down 3% year over year.
That's a huge red flag for a company positioned as a core AI growth engine.
A massive red flag. But the small revenue miss wasn't what caused the institutional panic. The report suggests the market freaked out over the forward guidance and the details of their investment strategy. The real concern was the specific announcement of delays in certain data center projects.
Okay, so what does that mean? Why is a delay so scary?
Think about the implications. Institutional investors have poured trillions into this sector based on the assumption of a massive, immediate, and continuous wave of AI capital expenditure, or CapEx. If a core AI infrastructure provider like Oracle is now delaying projects, it implies one of two things. Either the expected payoff might be further out in time than anticipated, or the immediate demand for new AI capacity is less urgent than the market had priced in. It just punctured that immediate return narrative.
And that skepticism was profoundly amplified by a severe negative surprise on their free cash flow, or FCF. This is perhaps the most damning indictment of the report. The consensus forecast was already negative at negative $5.2 billion, reflecting the heavy investment needed. But Oracle reported a staggering, nearly doubled negative $10 billion in FCF.
$10 billion in cash outflow in one quarter.
Exactly.
This severe cash outflow raised serious, immediate questions about the tangible return on investment in AI infrastructure. Investors are happy to tolerate negative FCF for a time if they believe the investment will yield exponential revenue growth in 12 to 18 months. But when you miss revenue and your CapEx runs double the expected deficit and you announce delays, institutional investors interpret that as a massive increase in risk and a much longer, more uncertain path to profitability. This forced a dramatic reassessment of every company reliant on that AI CapEx cycle.
Now, if Oracle gave us cause for concern and punctured the AI infrastructure balloon, Broadcom's results weren't just concerning, they were catastrophic. It created a paradox that truly broke institutional confidence. Broadcom AVGO reported its Q4 2025 earnings, and the resulting plunge was historic.
The Broadcom scenario is the ultimate definition of a market demanding perfection. Look at the facts. AVGO exceeded fourth quarter earnings expectations.
The beat earnings.
They beat. And they even projected their AI chip revenue to double next year. That, by any historical measure, is stellar AI-driven growth. So why the collapse?
Yeah. If they beat earnings and projected doubling their key growth driver, what could possibly scare the market into such an extreme reaction?
It was a failure of expectation management, pure and simple, combined with the underlying nervousness already fueled by Oracle. Investors were relying on extreme hockey stick growth projections, not just doubling, but maybe tripling or quadrupling, quantified precisely for the next fiscal year. Broadcom's stock plunged because the company failed to provide a specific, detailed 2026 AI revenue forecast.
So it wasn't what they said, it was what they didn't say.
Precisely. They gave an outline, but not the concrete numbers the speculative risk-on-growth crowd was demanding to justify the valuation. The failure to quantify that future revenue immediately spooked the market, leading to mass liquidation.
And this failure of expectation led to a historically unprecedented consequence. Broadcom experienced its largest single-day market capitalization loss in history. We're talking about a wipeout totaling a staggering $219 billion in a single trading session.
It's hard to even comprehend that number. To put that figure into perspective for you, that $219 billion loss surpassed the largest single-day market cap losses recorded by any of the other tech titans in recent history, including the massive crashes we've seen from Meta, Apple, and even the previous record holder, NVIDIA.
So $219 billion is more than the entire market cap of many established Fortune 500 companies.
Yes, many of them. This was not a correction. It was a wholesale, unprecedented display of capital flight and confidence collapse, driven purely by a lack of forward clarity.
And naturally, the reports confirm that this one event triggered a broad, coordinated sell-off across the entire AI and semiconductor ecosystem. Even the quality names suffered. NVIDIA, NVDA, immediately fell negative 3.27%, and Intel, INTC, declined 4.3% in sympathy. It just proves that fear spread quickly and indiscriminately.
This reaction highlights the extreme risk-off mood that now dominates the AI sector. The market is signaling a new, harsher reality. Merely promising future AI growth is no longer sufficient to justify multi-trillion-dollar valuations backed by massive, negative FCF-inducing CapEx. Investors now demand concrete near-term revenue certainty against those huge capital outlays. The narrative definitively shifted from buy the future no matter the cost to show me the money right now or I'm taking my capital elsewhere.
And beyond just the heavy hitters, the KING-KAMBUF reports noted broader areas of technology weakness, confirming the severity of the rotation across the sector. We saw companies relying on strong ad demand, like The Trade Desk, TTD, hitting 52-week lows. That confirms that advertising budgets are likely tightening in anticipation of economic uncertainty.
Telecom was also hit. with T-Mobile, TMUS, hitting 52-week lows, indicating pressure on consumer spending on high-end services. And we saw significant drops in infrastructure plays, with Cisco Systems, CSCU, dropping over 4%. This wasn't isolated. It was a sector-wide mandate to reduce high multiple risk.
And we absolutely must mention the exceptional weakness flagged in iRobot, IRBT. The stock was down a staggering 13.6% in one session. That contributed to an unbelievable year-to-date loss of negative 91.23%.
And while iRobot has its own specific challenges, its extreme fragility underscores a wider truth. When capital becomes scarce and rotation begins, the speculative companies relying on high growth, high multiple valuations are the first ones liquidated. This mass selling confirms that institutions are not waiting around for stabilization, they are aggressively de-risking their portfolios right now.
Okay, so we know where the money ran from, namely the high-flying, valuation-stretched AI names. The crucial question is, where did the institutions put that $219 billion plus all the other trimmed capital? This is where the Dow's strength begins to make complete sense, as the reports confirm a decisive rotation into sectors benefiting from broader economic strength and, critically, the recent dovish Fed policy.
The financial sector was the immediate and primary beneficiary, a textbook response to a rate cut. Following the policy announcement, the sector climbed strongly toward all-time highs. Look at Bank of America, BAC, which stands out with a powerful 68.47% YTD gain, hitting a fresh 52-week high.
That 68% YTD gain is not just a high number, it's a reflection of fundamental shifts. Why are financials so attractive right now, especially after a rate cut? Shouldn't lower rates be bad for them?
That's a common misconception. It's largely due to net interest margin, or NIM. The Fed cut was small, leaving the rate environment still relatively high at 4.75%. Banks benefit massively when rates are high because they can charge more for loans than they pay for deposits. A small, measured cut like this, the third of the year, signals stability and normalization, not panic. It confirms the banks can plan for continued high profitability without the extreme volatility of rapid rate increases. Hence, institutions flock to financial heavyweights like Wells Fargo and Morgan Stanley, which are also near their 52-week highs.
And let's not forget the payments processors. Visa showed immediate leadership, recording its best daily performance since April.
Visa and MasterCard are unique because they benefit from two trends: economic normalization and robust consumer spending, especially during the holiday season. They aren't dependent on volatile lending rates. They are dependent on transaction volume. Their immediate surge signaled confidence in the health and liquidity of the consumer.
Okay, so financials are number one. What about industrials? They also provided significant performance, fueling the Dow's record high. Caterpillar, CAT, is a prime example, approaching its 52-week high of $626.
This performance indicates strong underlying global activity in materials and heavy equipment. Institutions are rotating into companies like CAT because their earnings are tied to tangible cyclical strength. Infrastructure spending, mining activity, global construction. It's a clean, old economy narrative that offers a visible counterpoint to the volatile AI CapEx uncertainty.
The reports highlight a specific list of large-cap stocks that reached 52-week highs on December 11th, and it really validates this rotation thesis. You have Expedia in travel, General Motors in auto, Walmart in retail, and Johnson & Johnson in healthcare. This clearly shows capital moving into consumer-facing sectors with proven, tangible cash flows.
And shifting over to the true defensives, healthcare proved extremely resilient, maintaining its defensive demand. Johnson & Johnson, J&J, is near its 52-week high, and United Therapeutics, UTHR, boasts an incredibly strong 91% YTD gain. These sectors are attractive precisely because their demand is non-cyclical. People need healthcare regardless of interest rates or AI spending cycles. They offer crucial earnings visibility, which, after the Broadcom fiasco, is a highly prized commodity.
We also saw some fascinating, highly selective activity in consumer discretionary. While some retail suffered, the reports noted Tapestry, for instance, down over 16% in pre-market activity. Others surged. Lululemon Athletica, LUOU, actually jumped almost 10% after its CEO resignation was announced. What's that about?
The Lululemon move is a textbook example of behavioral finance in action. The sharp jump implies that the market viewed the current CEO's forthcoming departure, which is effective in Q1 2026, as a major turning point. It suggests there is a perceived turnaround opportunity under new leadership. It wasn't a positive reaction to the news itself, but a collective vote of confidence in the underlying brand and the belief that a new strategy is needed and imminent. It's a vote against the outgoing executive, essentially.
Interesting. And then there's Tesla, TSLA. It showed relative strength, posting a 2.7% gain for the week and maintaining a powerful 38% YTD performance. It seems to be benefiting from capital flowing out of the pure AI infrastructure stocks.
Exactly. Tesla is positioned uniquely. While it uses AI, the market is currently viewing it as a consumer technology and EV leader, not a pure-play semiconductor proxy like NVIDIA or Broadcom. When investors liquidated their risk in those chip names, some of that capital flowed into TSLA as the designated large-cap growth stock outside of the direct hardware dependency.
Finally, we must spend some time on the definitive safe haven surge in commodities, which seriously reinforces the cautious tone running through these reports.
The gold story is enormous. It settled at $4,300 per troy ounce, continuing a robust uptrend. And look at the annual gain, a massive head-turning 65% YTD gain. This is far beyond typical gold performance.
Oh, such a huge move.
The drivers are textbook, but amplified. You have extreme safe haven demand against geopolitical uncertainty, the psychological impact of the Fed rate cut, reducing the opportunity cost of holding non-yielding assets, and widespread demand for inflation hedging, especially given Powell's acknowledged lingering inflation concerns.
And silver isn't just following, it's leading, hitting fresh all-time record highs.
Silver is benefiting from both the monetary aspect, the safe haven, the inflation hedge, and its industrial component. The surge implies strong forward demand from industrial applications, likely in the green energy transition and electronics, confirming the fundamental rotation into materials. The entire energy sector also showed resilience. Money flowing out of speculative tech is actively seeking stable assets tied to inflation and global commodity needs, and that confirms the severity of the institutional risk assessment.
This section is where we pull back the curtain on the underlying risk profile, combining technical indicators with critical flow data. The picture painted by KMBU is one of extreme, almost contradictory market positioning, which demands caution.
Let's start with the market fear gauge, the VIX, or the volatility index. It's elevated, but it remains in the moderate 17 to 18 range. Historically, the 20 level is the threshold that signals high stress or panic.
So the VIX isn't screaming panic sell, but it's definitely showing increased anxiety compared to the placid days earlier this year. What does that moderate VIX reading tell us about investor psychology?
It gives us a mixed, and I would argue, almost dangerous interpretation. It shows market caution. The uncertainty driven by the massive AI sector sell-off is registering in the options market. But, paradoxically, it also suggests market complacency given how stretched valuations are and the scale of the rotation we just detailed.
What do you mean by that?
A massive, historic $219 billion loss occurred in one stock, yet the VIX barely kissed 20 before subsiding. This indicates that while traders are quick to hedge policy risks, like a Fed decision, they might be severely underestimating the fundamental valuation risks inherent in the top 10 stocks.
Speaking of complacency, let's look at the retail investor. The flow data provided in the KMBUF reports is genuinely staggering and provides one of the clearest contrarian signals we've seen all year.
This is the data point that should make every prudent investor pause and think. Retail investor flows are tracking at an unprecedented 1.9 times the 5-year average. To give that some context, this level of retail participation is actually 14% above the peak volumes we saw during the famous meme stock and cryptomania peaks of 2021.
Wow, that's the classic, my Uber driver is telling me what stock to buy moment, but scaled up beyond the point of reason. Weekly flow reached $7.8 billion, which is significantly above the $6.3 billion average. What happens when retail confidence is this high?
Historically, nothing good happens immediately after. This retail enthusiasm, coupled with a highly stretched market and peak valuations, is the textbook definition of a major contrarian warning signal. When the retail herd is maximally committed, the smart money, the institutions, usually starts quietly exiting.
And that institutional caution is explicitly supported by Bank of America's Bull and Bear indicator. The report shows that indicator stands at 7.8, just 0.2 points away from the extreme bullishness warning level, which is 8.0 or higher.
This is critical intelligence. When the B&B indicator nears that 8.0 sell signal, cautious institutional investors interpret this as the market having priced in nearly all positive news and having very little room left to climb without a correction. The reports confirm this dynamic is playing out right now. Institutional investors are gradually beginning to withdraw or hedge aggressively, even as retail investors pour money in, chasing the final bits of momentum. It's a classic setup for a potential reversal.
Now let's discuss the single greatest root cause of this required caution. Valuations, particularly market concentration. We know the S&P 500 forward PE is elevated above its historical 16 to 18 times average. But the true systemic risk lies in the concentration.
The concentration risk is, frankly, alarming. The top 10 stocks in the S&P 500 now represent approximately 33% of the entire index weight. If those 10 companies underperform, the market cannot possibly hold up. But the valuation on these specific companies is the real issue. These 10 stocks, the former AI leadership trade, at an average PE multiple of roughly 30 times forward earnings.
30 times forward earnings for one-third of the market cap. That sounds high, but let's give it some historical weight. How does that compare to previous market peaks?
It places us firmly in extreme historical territory. This PE level for the market leaders matches the valuation peak seen during the dot-com bubble in the year 2000. In 2000, multiples were also concentrated in that 25 to 30 times range, driven by the excitement over the internet revolution. Furthermore, this concentration and valuation level nears the severe extreme seen leading up to the infamous 1929 market crash, which saw market leaders trading at 30 times or even higher multiples.
That's a heavy historical comparison, the dot-com bubble and 1929 peaks. But let me play devil's advocate. Isn't today different? This is AI. Genuine productivity gains, not just pure speculation on revenue-less websites like in 2000. Why should we assume the valuation metrics apply the same way?
That is the essential debate right now, and it's a valid point. AI does promise structural, explosive productivity gains that the internet promised but arguably didn't deliver immediately. However, the risk is not in the technology. The risk is in the price you pay for the promise. In 2000, investors paid 30 times earnings for companies that weren't generating cash flow. Today, we are paying 30 times earnings for companies that, as we saw with Oracle and Broadcom, are either showing severe cash outflow or failing to clearly quantify the near-term revenue certainty required to justify that price. The concentration risk is what binds these periods together.
Meaning the market structure is just fragile.
Exactly. The concentration risk is critically high. Narrow market leadership means any major reversal or continued deterioration in the earnings outlook for these 10 largest stocks, which is exactly what the Broadcom failure represents, could trigger a sharp, disproportionate market decline. The analyst consensus bear case scenario cited in the KING-KAMBUF reports is soberingly clear. If these structural valuation problems resolve through a major pullback, the S&P 500 could fall potentially to the 5,800 to 6,000 range. That is why this rotation is not just about trading. It's about protecting your core capital.
That structural risk assessment really sets the stage for where we need to be extremely careful and selective. Now, let's pivot entirely to the actionable advice provided in the Financial Digest report. KBUF provides specific tactical recommendations for both swing traders, those looking for moves over several days, and aggressive day traders. The primary focus here is capitalizing cleanly on the rotation we just spent all this time diagnosing.
The swing trade opportunities emphasize the decisive shift away from pure, high-multiple technology and into quality growth or stable rotation beneficiaries. These trades are designed for a 3 to 10-day holding period, relying on strong technical support and resistance levels.
Let's run through the top 5 stocks identified with the best spread opportunities. I want to focus on the rationale behind the trade, not just the numbers.
First up, Lululemon Athletica, LULU. The technical setup here is that the stock is basing out following the management surprise news, which suggests the downside risk has been priced in. The fundamental rationale is consumer discretionary strength combined with a brand that has proven resilient. KMBUF recommends an entry between 205 and 207, targeting 220 to 225.
And that entry range is right on a key support level, I assume.
Yes, it sits right on a key technical support level, with a tight stop loss at $200, defining the risk very clearly.
Okay. Next is Tesla, TSLA. This is a momentum play, right? The stock is holding its 50-day moving average strongly despite the broader tech turmoil.
It is, and the reports see it as a beneficiary of capital flowing out of the AI ecosystem and into recognizable high-growth names that offer a clear differentiation from the chip space. The entry range for TSLA is recommended at 450 to 455. This is slightly below its Friday close, anticipating a technical retest of support before a bounce. The target is ambitious, 480 to 495, and the stop loss is set at 435. The trade assumes the structural momentum up over 38% year-to-date will continue to attract capital-seeking growth outside of the immediate correction zone.
Then we move squarely into the rotation centerpiece. Bank of America, BAC. The financial sector strength is undeniable, as we discussed, driven by the expectation of continued favorable net interest margins.
And BAC is technically positioned very well. The report suggests the recommended entry of $54.50 to $55 is precisely where a high-volume node appears on the charts, offering established technical support. This entry targets $58 to $60, capitalizing on the continuing sector rotation with a protective stop-loss at 53. This is one of the highest conviction rotation plays identified in the report.
The fourth pick is an interesting one, a media sector rotation play, Warner Bros. Discovery, WBD. While maybe less discussed than the financials, it boasts an exceptional YTD performance of plus 172%. What's the trade rationale here?
WBD represents a value-oriented momentum play in the media space, which is consolidating and restructuring. That massive year-to-date gain of over 170% indicates strong institutional interest in the turnaround narrative. The recommended entry is tight, $29.50 to $29.75, targeting a break toward $32 to $34. The thesis is that this momentum continues as investors seek high-growth stories with clearer valuation metrics than mega-cap tech, protecting the downside with a stop-loss at $28.50.
And finally, Visa rounds out the top five. Pure financial sector leadership, stable business model.
The V-trade is a confirmation play. It benefits directly from holiday spending volume and the recent Fed dovishness. The recommendation is simply to enter on dip support levels, specifically buying weakness in the 275 to 280 range with a target of new all-time highs. This is a blue chip holding trade leveraging sector strength.
Now, for those aggressive traders using specialized strategies, let's talk about the TKIF 20-plus day trading opportunities. What exactly is the TKIF model?
The TKIF 20-plus model, for those unfamiliar, is a quantitative strategy KAMBUF uses that focuses on identifying extreme, short-term mean reversion opportunities based on proprietary volatility measurements. Essentially, it targets stocks that have moved so far, so fast, that a sharp reversal is mathematically probable within the next 5 days. These are high-risk, high-reward plays, often capitalizing on extreme technical conditions like oversold bounces.
And the first two trades are straight recovery plays out of the tech correction. Broadcom, AVGO, the company that lost $219 billion, is flagged as a recovery opportunity. That takes serious guts.
The thesis here is pure technical capitulation. The massive loss suggests a final washout of nervous sellers, potentially creating a technical recovery bounce, or as you might call it, a dead cat bounce, which high-frequency traders can capitalize on. The high-risk entry is $350 to $355, targeting $380 or higher. This requires minute-by-minute vigilance and confirming institutional buying volume.
Similarly, NVIDIA is flagged as an institutional dip buy opportunity, but at slightly less extreme levels.
Right. It's a quality stock under sector pressure. The recommended entry is 172 to 176, specifically testing a strong historical support level from late Q3. The target is a quick pop back toward 190 plus. This acknowledges that while the sector is selling off, the long-term quality of NVIDIA makes it attractive at a deep discount for quick-turn traders.
The reports also highlight some extreme outliers in the speculative zone, demonstrating the volatility appetite of day traders. Zedge Inc., ZDGE, is flagged due to its astronomical 87,000% YTD gain. That number is almost impossible to believe.
It is indeed an almost unbelievable number, indicating massive short squeezes and incredible volatility. This is a high-volatility, pure momentum play, recommended with an entry range of 270 to 280, targeting 295 to 330. This requires constant vigilance due to the extreme risk profile and low liquidity inherent in such moves.
Another momentum breakout is Pulmatrix Inc., PULM, showing a sharp 15% gain on Friday.
The technical setup for PLM is a clear, short-term momentum breakout through resistance. The entry is tight, 450 to 465, targeting 510 to 520. These are textbook breakout trades for the aggressive day trader.
And finally, a potential bounce trade in media. Netflix, NFLX.
NFLX is a volume leader, and the setup is based on technical support. Buy at the $94 support level, targeting $97 to $99. This is a clear, short-term rebound trade, anticipating consolidation at key levels.
Let's shift to the long-term view now. Portfolio positioning is the so what for long-term holders. KAMBUF provides a clear strategic allocation framework emphasizing defensive positioning. We need to understand the logic behind this major rebalancing.
The actionable strategy is decisive and reflects the valuation concerns we raised earlier. The mandate is to significantly reduce exposure to pure AI and mega-cap tech, bringing that exposure down to 20% of the overall portfolio. That's a sharp reduction from the 35% allocation that many portfolios were carrying mid-year.
That's a 15-point capital rotation out of the engine that drove the market for the last 2 years. Where exactly is that capital moving and why those specific percentages?
It rotates into the newly identified leaders. The recommendation is to increase financials to 15%, healthcare to 15%, and materials and energy to 12%. The logic is sound. That 15% in financials is specifically designed to maximize exposure to net interest margin expansion if the Fed remains cautious. Healthcare at 15% provides the essential defensive buffer, and materials and energy at 12% is the inflation hedge, capitalizing on the strength we saw in gold and silver. This shift prioritizes defensiveness, value, and sectors, benefiting from commodity inflation and economic normalization over speculative growth.
Critically, they also recommend maintaining a substantial cash buffer of 5 to 10% or even 10 to 15% for more conservative investors.
That cash is absolutely essential. It serves two functions. First, it's a dry powder hedge against a potential major reversal fueled by those stretched valuations. If the S&P falls to 6,000, you have the capital to deploy. Second, it allows you to capitalize on the high volatility created by this rotation, enabling you to buy quality names at unexpected discounts.
And since the VIX is elevated in that 17 to 18 range, they stress tighter risk management rules for all new positions.
Discipline is the only defense against market complacency and volatility. For swing positions, the rule is a tight 5 to 6% stop loss. For aggressive day trades, the maximum stop loss is a tiny 2 to 3%. Furthermore, they stress scaling out of winning positions. Take partial profits at plus 10%, plus 20% gains, and then trail your stops aggressively after a 15% gain to protect capital. In a rotation phase like this, capital preservation is paramount.
Finally, we need to look ahead. What are the key economic indicators to monitor in the upcoming week that could either affirm this rotation or send the market into a new frenzy?
The reports detail a full slate: initial jobless claims, retail sales, and the Producer Price Index, or PPI. But the most critical data point of all, the one that defines 2026 Fed policy, is the Consumer Price Index, the CPI release.
And the implication of that CPI reading is huge for this rotation, isn't it?
It is the determinant. Inflation readings will entirely determine the trajectory of 2026 Fed policy. If inflation remains surprisingly hot, it will strongly support the financial and cyclical stocks by suggesting rates will stay higher for longer, benefiting banks and industrials. If inflation rapidly declines, it might soften the rotation and potentially allow some quality tech names to consolidate. But it will directly influence the broader economic outlook that the current financial and cyclical strength relies upon. It's the metric that will either validate or disrupt the entire strategic rotation.
So what does this all mean for you, the learner? The reports from KING-KAMBUF confirm we've entered a necessary, healthy, albeit painful transition phase in the market. The age of buying anything remotely related to AI unconditionally, justifying any price multiple purely on future promises, is definitively over. The market has shifted its demand signal from potential to quantifiable certainty. We saw the market achieve incredible highs, the S&P hitting 6,901, the Dow reaching 48,704, but those gains were achieved on the back of financial and industrial sectors taking decisive leadership away from mega-cap technology. Those overall index gains were completely masked by a severe historic correction in bellwether names like Broadcom, which lost a record $219 billion in a day due to a failure to meet extreme valuation expectations. The institutional money is flowing into sectors with solid fundamentals, clear earnings visibility, and defensive characteristics. That means banks, industrials, consumer staples, and healthcare. Meanwhile, retail investors show peak bullishness, with flows at 1.9 times the 5-year average. This makes selectivity, discipline, and tight risk management absolutely paramount for anyone entering the market this week.
And if we connect this to the bigger picture, given the S&P 500 PE multiples for the top 10 stocks now match historical bubble peaks, specifically the dot-com era and the 1929 peak, and knowing that the prevailing analyst consensus targets for the S&P 500 in 2025 are mostly below current market levels, this raises an important question that you must consider. Are we witnessing the final, necessary stages of the mega-cap tech rally being replaced by sustainable, broad market leadership that can propel us higher through 2026? Or is this AI correction merely a temporary pause before the broader, historically extreme structural valuation problems trigger a more serious index-wide pullback that resets the entire market into Q1 2026? Keep that question central in your analysis as you monitor the upcoming CPI data. The answer will define not just the next week, but the first quarter of next year. Thanks for taking this deep dive with us. We hope you feel better informed and ready to approach the market with discipline and critical thinking. We'll catch you on the next deep dive.